What if the smartest money move is not a move at all? A calm refusal to chase hype. Today, we slow the noise, sharpen our judgment, and let Benjamin Graham show us how to win by being boring. On purpose, welcome to The Intelligent Investor. Before we dive in, a quick note. This is education, not financial advice. My job here is to make Graham's wisdom practical and human. Your job is to decide how it fits your life. Let's begin with a simple idea that redefines everything. Are you an investor or a speculator? A speculator treats the market like a casino. He chases price. He trades because he's excited or afraid or bored. He wants action. And action, Graham reminds us, is expensive. An investor is different. An investor buys a piece of a real business at a rational price, with room for error, and plans to hold it while it grows. An investor treats the stock market as a servant, not a master. The investor's posture is steady, patient, grounded. So how do you become that investor? Graham hands us 3 timeless tools: a character to remember, a rule to live by, and a plan you can actually follow. First, the character. Mr. Market. Imagine you have a business partner. Every day, he knocks on your door and offers to buy your share of the business or sell you his at a new price. Some mornings he's euphoric and quotes a ridiculous number. Other days, he's depressed and practically gives the business away. Mr. Market is moody, impulsive, and absolutely relentless. You don't have to answer the door every day. Ignore Mr. Market when he's manic. Ignore him when he's miserable. Act only when price truly serves you. Second, the rule: margin of safety. Think like an engineer building a bridge. If you expect a maximum load of 10 tons, you design for 30. Not because you lack confidence, but because reality is messy. Businesses stumble, leaders change, economies turn. By insisting on a margin of safety, a meaningful gap between a company's true value and the price you're paying, you protect yourself from the unknown. Here's what that sounds like in practice. You don't buy a wonderful story at a wonderful price. You buy a solid business at a sensible price, and you make sure the numbers leave you room if things go wrong. That room, your margin of safety, is the difference between a temporary dip and a permanent loss. Third, the plan. Choose your temperament first, then your method. Graham divides investors into 2 temperaments: the defensive investor and the enterprising investor. The defensive investor values simplicity, sleep, and long horizons. Their plan is conservative by design. They diversify broadly, pay low fees, add money on a schedule, and do very little else. They know that time in the market matters more than timing the market. They balance stocks and bonds, and they rebalance calmly when the mix drifts. Graham's baseline? Keep a sensible balance, often around the middle, and shift only within broad guardrails. If stocks run hot, trim a little and refill bonds. If stocks fall hard, add a little to stocks. He suggests avoiding extremes and keeping both assets in the portfolio so you never bet the farm. The enterprising investor is different. This person is willing to do more work, real work, to find mispriced securities, not hype, not rumors work, studying financial statements, comparing price to assets, to earnings, to dividends. Looking for situations where the math is obviously in your favor and the downside looks contained. The enterprising investor earns the right to be selective by being relentlessly prepared. So which are you? If your life is busy, your patience is limited, or your heart races when prices jump, Graham nudges you toward the defensive camp. Which, by the way, has a proud record: low cost, diversified, automatic, effective. If you genuinely love digging through numbers, if you enjoy the hunt, and if you can keep your emotions under control, then the enterprising path might fit, but never both at once. Choose your lane. Let's make this concrete. For the defensive investor, the engine of progress is consistency. You can dollar cost average, investing a fixed amount at regular intervals, so you buy more shares when prices are low and fewer when they're high. That rhythm trains you to ignore Mr. Market's mood and trust your plan. Lower fees matter. Broad diversification matters. A simple mix of stock funds and bond funds can do a remarkable job if you stick with it through good weather and bad. Rebalancing is your quiet superpower. When stocks soar and overwhelm your target, you trim and refill bonds. When stocks sink and your mix is light, you add to stocks. Notice what you're doing. You're buying low and selling high, without guessing, without drama. The rules do the heavy lifting so your emotions don't have to. Graham also offers a quality filter for those who buy individual stocks in defensive mode. Think large, conservatively financed companies. Look for a long record of paying dividends. Favor firms with steady earnings over many years. Demand a sensible price relative to earnings and assets. In other words, you're not searching for the next rocket ship. You're looking for real businesses that have behaved like adults for a long time and are priced like they'll keep doing exactly that. For the enterprising investor, Graham describes several hunting grounds where mispricing tends to live. He points to companies selling below the value of their net assets. He points to temporarily unpopular industries where prices have overshot to the downside. He points to special situations where corporate actions, spin-offs, restructurings, liquidations, create forced selling and neglected pricing. But he adds a warning label. Effort is not a substitute for discipline. If you do the work, do all the work. Build a checklist. Demand a real margin of safety. Spread your bets across multiple ideas so a single mistake can't sink you. And have the humility to walk away when the numbers don't give you enough room. Every path returns to temperament. The market will test you. It will go up when you're afraid to buy and go down after you finally give in. It will reward nonsense for a season and punish discipline for a season. Graham's answer is character. He asks you to be the person who can hold a good plan when it feels lonely, who can say, "I don't know," when others pretend they do, who can accept that volatility is not the same thing as risk. Volatility is the waves. Risk is the hole in the boat. Let's talk about inflation and bonds, the quiet, often misunderstood side of a portfolio. Inflation erodes purchasing power over time. Bonds can dampen volatility and give stability, but they also face their own risks when rates move or purchasing power slips. Graham's solution isn't to predict inflation or rates, it's to balance. Keep a meaningful bond allocation for ballast. Keep a meaningful stock allocation for growth. Revisit the mix at intervals and make modest adjustments, not bold bets. Dividends deserve a moment too. A long, consistent dividend record is a sign of discipline, both in the business and in its capital allocation. Dividends won't make a bad company good, but they often signal quality and provide a tangible component of total return. For many investors, dividends are the kind of quiet progress that's easy to underestimate and wonderful to experience. Now, a word on forecasts. Graham had little patience for confident predictions. Most forecasts tell you more about the forecaster than the future. Your edge is not in guessing where the market will be next month. Your edge is in buying sensibly today, with a margin of safety, and giving time the respect it deserves. So how do you put this to work on Monday morning? Start with a written policy. 2 or 3 pages, plain language. What's your goal? What's your risk tolerance? Which temperament fits you, defensive or enterprising? What's your target mix of stocks and bonds? How often will you add money? When will you rebalance? What will you avoid? If you're defensive, your policy might say, "I'll invest a fixed amount monthly. I'll hold a broad stock index fund and a broad bond fund. I'll target a balanced mix, and I'll rebalance once or twice a year. I'll ignore headlines, never chase hot funds, and never buy an individual stock because a friend told me to." If you're enterprising, your policy might say, I will hold a core of diversified funds, plus a basket of carefully chosen value opportunities. I will buy only when I can articulate the margin of safety in writing. I will limit position size. I will spread across several ideas. I will review each thesis quarterly, update the numbers, and admit when I'm wrong, quickly. Build a pre-commitment checklist. Before you buy any single stock, ask, do I understand the business in one paragraph? Is the balance sheet conservative? Are earnings and cash flow consistent over many years? Is the price meaningfully below a sensible estimate of value? What breaks my thesis? How will I know? What am I assuming that might be wrong? If I wake up tomorrow and the price is down 20%, is my plan to add or to panic? Write the answers down. If you can't write them, you don't own the business. You own a hope. Let's address emotions, because no plan survives contact with your heart without practice. When prices are falling, your brain plays tricks. It whispers that the pain will never end. It drags short-term noise into long-term decisions. Graham's antidote is structure. If you rebalance by rule and buy on a schedule, you turn scary moments into opportunities, automatically. When prices are soaring, your brain plays different tricks. It says you're a genius. It tempts you to make exceptions to your standards. It tells you to borrow confidence from other people's excitement. Graham's antidote is the same. Structure. Trim to your target, refill your ballast. Say no to the just this once purchase that violates your policy. There's a quiet dignity to this kind of investing. It's not sexy. You don't get applause for not panicking. You don't trend for staying the course. But over a working lifetime, the gap between a disciplined investor and an impulsive speculator grows and grows and becomes the difference between anxiety and freedom. Now, some common traps Graham would ask you to avoid. First, confusing a good company with a good investment. A wonderful business can be a poor investment at the wrong price. Price matters, value matters, margin of safety matters. Second, falling in love with narratives. The story might be true, the price might still be wrong. If the math doesn't leave room for error, move on. Third, overtrading. Activity feels like progress. It's often the opposite. Costs stack up, taxes stack up, mistakes compound. Your edge is selective action, not constant motion. Fourth, ignoring the balance sheet. Debt is a fair weather friend. When times are easy, leverage looks like magic. When the storm hits, leverage is an anchor around your ankle. Favor resilient finances, especially when you don't know what's next, and you never know what's next. Fifth, chasing yield. A high dividend can be a gift. It can also be bait. Look at payout ratios, cash flow coverage, and the company's record across cycles. If the dividend depends on perfect conditions, it isn't a margin of safety, it's a trap. Let's return to Mr. Market for a closing story. Imagine two neighbors. One is Mr. Market. Every day he shouts over the fence, "Buy from me, sell to me, prices are up, prices are down." He's entertaining. He's loud. He's always there. The other neighbor is time. Time doesn't shout. Time plants a seed, waters it, prunes it, and waits. Time looks like nothing is happening until everything has happened. Graham's point is simple. Be a friend to time. Be polite to Mr. Market, but never let him lead. If you want a small habit that captures Graham's philosophy, try this. Once a year, write yourself a letter as if you're advising a friend. Here's my goal, here's my plan. Here's what I will do if the market rises or falls by 20%. Here's what I will never do. Sign it, date it, put it in your desk. When the storm comes, and it will, you're not deciding from scratch. You're following the you who was calm, rested, and rational. And if you want a small question that keeps you honest, ask, if this stock never traded again for 5 years, would I still be happy to own the business? If the answer is no, why are you buying it? Let's bring this home. The intelligent investor isn't about clever tricks. It's about character, your character. It's about building a margin of safety into your choices, using Mr. Market rather than obeying him, and choosing a plan that matches your temperament so you can live your life while your money quietly does its work. You don't need to predict the next move. You need to protect your next decade. So here's your action list, distilled to its essence. Pick your lane, defensive or enterprising. Put it in writing. If defensive, set a balanced mix of stocks and bonds. Automate monthly contributions, rebalance once or twice a year, and keep fees low. If enterprising, build a research checklist. Insist on a wide margin of safety. Diversify across several independent ideas, and review your theses on a schedule. For everyone, respect dividends, respect balance sheets, and respect the difference between price and value. Ignore forecasts, trim euphoria, cushion fear. Let time compound quietly in your favor. If this resonated, drop the one rule you'll live by for the next decade in the comments, and share this with a friend who needs a quieter plan. Stay steady. Invest intelligently. Let time do the heavy lifting.